In this module, we will be discussing the nature and characteristics of current liabilities. In general, a current liability involves future disbursements of assets or services. Know that a liability has three essential characteristics. A, it is a present obligation. B, it requires a transfer of economic resources. And C, it arises from past events. Liabilities are classified on the Statement of Financial Position, aka the balance sheet, as either current liabilities or non-current liabilities, or you may translate that as long-term liabilities. Current liabilities are those obligations whose liquidation is reasonably expected to be settled within the normal operating business cycle, or 12 months after the reporting date. Now we talk about accounts payable. Accounts payable represents obligations owed to others, that is, other businesses, for goods, supplies, or services purchased on an open account. Now contrast that with a notes payable. A notes payable is a formal written promise to pay a certain amount of money on a specific future date. And this may arise from past sales or some financing arrangement or other transactions. Notes payable may be classified as short-term or long-term, depending on the payment due date. Short-term notes payable, resulting from borrowing funds from a lending institution, may be interest-bearing or they may be zero interest-bearing. Now, interest-bearing notes payable are reported as a liability at the face amount of the note, along with any accrued interest payable to that date. However, a zero interest-bearing note does not explicitly state an interest rate on the face value of the note. Interest is the difference between the present value of the note and the face value of the note at maturity. For example, let's take this company that issues 150,000 euros, 1 year, zero interest bearing note that has a present value of 138,000 euros. That's the present value. The entry to record this transaction would be as follows. You record it at the present value: debit cash 138 and credit notes payable 138. The interest that accrues over the term of the note, that is the 12,000, the difference between 138 and 150, will increase the balance of the notes payable account to 150. At maturity, the amount paid, 150, is the initial amount recorded plus total interest expense recorded during the period that the note was outstanding. The currently maturing portion of non-current, that is long-term debts, may be also classified as a current liability. When a portion of a long-term debt is so classified, it is assumed that that amount will be paid within the next 12 months of the funds classified as current assets. Now, cash dividends payable once declared by the company are also classified as current liabilities during the period between the declaration and prior to the payment. Once declared, a cash dividend is a binding obligation of a corporate entity to pay its shareholders. A company also sometimes receives cash in advance of the performance of a service or the selling or issuing of some merchandise. Such transactions result in a credit to be deferred, or was better known as unearned revenue account. Now, unearned revenue, remember, is classified as a current liability on the balance sheet. As the claims of this nature are redeemed, the liability is reduced and the revenue account is credited. Other liabilities, there are current tax law requires most business enterprise to collect sales tax from customers during the year and periodically remit these collections to the appropriate government unit. In such instances, the business is acting as a collection agency for the government. If tax amounts due to the government are on hand at the time the financial statement has been created, they are reported as current liabilities. Now, there's a whole category also of employee-related liabilities. These include amounts owed to employees, such as salary and wages payable on the accounting period and reported as a current liability. Other items related to employee compensation are also reported as current liability. Any payroll deductions taken from the employee and held by the company are recorded as a liability. Compensated balance absences are reported as well as bonuses. Now, you should know that compensated absences are absences from employment, such as a vacation, illness, maternity, paternity, or jury leave. In connection with compensated balances, vested rights exist when an employer has an obligation to make payment to an employee, even if that employee has been terminated. Also, there are accumulated rights. These rights are those that the employees carry forward to future periods, if not used in the period in which they are earned. Any amounts for vested rights that have accumulated during the period must be recorded as an accrued liability or accrued expense and carried as a current liability. Now, this has just been a brief overview of current liabilities.